Welcome to a webinar on the new insurance contract standard IFRS 17. This webinar is part of a series of materials that the ISB will be producing to support the implementation of the new insurance contract standard. My name is Joanna Yeo. I'm a Senior Technical Manager on the Insurance Contracts project. I'm joined today by Andrea Pride, also on the Insurance Contracts project, and is lead on that project. Before we start, as per usual, the views expressed in this presentation are those of our own, and not those of the International Accounting Standards Board or the IFRS Foundation. A copy of the slides used in this presentation is available for download from the website. Those slides are accompanied by additional material which we hope you will find useful.
IFRS 17 is the first truly international standard for insurance contracts. It replaces an existing IFRS standard, IFRS 4. IFRS 4 is an interim standard that has allowed entities to continue to use their accounting practices that existed prior to their first adoption of IFRS standards. The range of differences in the accounting practices previously used makes it very difficult today for investors to compare and understand the insurance business. IFRS 17 changes all that because it requires consistent accounting for all insurance contracts based on a current measurement model. That current measurement model and the consistency created by IFRS 17 will aid in investors' analysis by allowing them to compare insurance business in different jurisdictions and within jurisdictions more easily. IFRS 17 will also provide improved information about insurance contracts, providing useful information about the profitability of insurance business. Companies will be required to apply IFRS 17 for annual periods beginning on or after 1st of January 2021. When companies first apply IFRS 17, they will be required to restate comparative information for 1 year. Companies will be allowed to apply IFRS 17 before 2021 if they should choose to. The objective of today's webinar is to provide a high-level overview of IFRS 17.
Today's webinar will cover firstly, the scope of IFRS 17, which contracts is IFRS 17 applicable to. We will then discuss what is a contract for the purposes of IFRS 17 and provide a high-level overview of the IFRS 17 current measurement model. When discussing the scope of IFRS 17, we'll be highlighting differences between the scope of IFRS 17 and the existing insurance contract standard IFRS 4. It would be helpful before listening to this webinar if you had an understanding of the current scope in IFRS 4. However, this is not strictly necessary. IFRS 17 applies to the accounting of insurance contracts and not on the accounting for insurance entities. This is the same as existing IFRS 4. An insurance contract is where the policyholder transfers its significant insurance risk to the issuer. The issuer then promises to compensate the policyholder on the occurrence of an insured event. Typical examples of an insurance contract are motor insurance, where the insurance risk is the losses suffered on accidents, or life insurance, where a payment is made to the beneficiaries on the death of an insured person. A common question we get is whether annuities are also insurance contracts. Annuities pay a regular amount to the policyholder. Some annuities are within the scope of IFRS 17. These are annuities that transfer significant insurance risk. These annuities agree to pay the policyholder a fixed sum throughout the life of the policyholder. The uncertainty is the uncertainty over how long a policyholder will live. The policyholder transfers its significant insurance risk, which is their form of uncertainty over how long he or she will live and whether it has saved sufficiently for its retirement. Another question that we get is whether derivatives are in insurance contracts. Some derivatives are insurance contracts, but not all derivatives are insurance contracts. A derivative must transfer significant insurance risk to meet the definition of an insurance contract. For example, the policyholder must have a pre-existing non-financial risk, and the insured event must have an adverse effect on the policyholder. The definition in IFRS 17 is the same as the definition in IFRS 4. although there are two minor changes to the guidance in IFRS 17, but this is not expected to result in changes in assessments for the majority of contracts. This slide discusses insurance contracts which are excluded from the scope of IFRS 4 and is instead accounted in other IFRS standards. This is not a change from IFRS 4. Some examples are, firstly, a warranty that's issued by the manufacturer. However, warranties that are issued by third parties remain within the scope of IFRS 17. The second example is a retirement benefit obligation issued by defined benefit plans. The third is an insurance contracts that are held by an entity, that is, the entity is a policyholder instead of an issuer. Those contracts are outside the scope of IFRS 17 unless those contracts are reinsurance contracts. There are two options to account for some insurance contracts using either IFRS 17 or other IFRS standards. The first is financial guarantee contracts. The option is to account either using IFRS 17 or the financial instrument requirements. This is not a change from IFRS 4. The second are specified fixed fee service contracts, which the option is to account for these contracts either within the scope of IFRS 17 or IFRS 15, which covers revenue recognition. Examples of such contracts is a maintenance contract in which the service provider agrees to repair specified equipment when the equipment breaks down. Another typical example is a car breakdown service, in which the provider charges a fixed annual fee to provide roadside assistance. This is a change from IFRS 4. The earlier slides discuss insurance contracts where the entity is the issuer of insurance contracts. However, as discussed before, the scope of IFRS 17 also includes contracts where the entity is a policyholder instead of the issuer, but only when those contracts are reinsurance contracts. In this case, the policyholder transfers its significant insurance risk, which arises from insurance contracts that have been issued by the policyholder. The reinsurer, the issuer of the insurance contract, promises to compensate the policyholder for claims arising from the insurance contracts issued by the policyholder. The definition of a reinsurance contract is the same in both IFRS 4 and IFRS 17. However, as noted before, there are two minor changes to guidance, but this is not likely to result in changes in assessments for the majority of contracts. The scope of IFRS 17 also includes contracts without significant insurance risks. These contracts are investment contracts with discretionary participation features, which are issued by an entity that also issues an insurance contract. These contracts are financial instruments with discretionary payments. This is a change from IFRS 4. We have been talking a lot about insurance contracts, but what is a contract for the purposes of IFRS 17? An entity will need to consider its substantive rights and obligations, whether they arise through the contract, by law, or regulation. A contract is an agreement between two or more parties that creates enforceable rights and obligations. Enforceability is a matter of law, and contractual terms can include all explicit or implied terms, including those arising from law or regulation. Contracts vary across jurisdictions, and therefore an entity will need to apply judgment to determine what are its substantive rights and obligations. An entity will also need to disregard terms that have no commercial substance in doing so. After deciding what a contract is, and it is an insurance contract under the scope of IFRS 17, this slide addresses what is then measured under IFRS 17. Firstly, an entity would need to identify and separate specified non-insurance components and to account for those non-insurance components using other IFRS standards. Firstly, specified embedded derivatives. Secondly, distinct investment components. Both of these would then be accounted for using IFRS 9. The third thing that an entity would need to identify are distinct goods or non-insurance services, and to apply the revenue recognition requirements to those distinct goods or non-insurance services. an entity is prohibited from separating further non-insurance components. For the measurement purposes, an entity then applies IFRS 17 to remainder of the cash flows after separating those specified components.
IFRS 17 requires a company to measure its insurance contracts as the sum of the fulfillment cash flows and the contractual service margin. The fulfillment cash flows represent a present value of probability-weighted expected cash flows, and it's also adjusted with an explicit risk adjustment to reflect the uncertainty in the insurance risk. The contractual service margin represents the profit that the company expects to earn as it provides insurance coverage. Together, these two components make the IFRS 17 asset or liability. We'll be providing a future webinar that goes into these components in more detail. IFRS 17 includes modifications to the core requirements. There's a modification for insurance contracts with direct participation features, which reflects the investment-related nature of those contracts. There's a modification for reinsurance contracts held, which reflects the fact that this is a service that an entity has purchased rather than a service that the entity provides. And there's a modification for investment contracts with discretionary participation features, which reflects that those contracts don't provide insurance coverage. IFRS 17 includes a simplified measurement approach, the premium allocation approach, which can be applied to insurance contracts with a short coverage period. We'll be providing more information about most of these modifications in future webinars.
This slide highlights key changes that we expect to see when moving from IFRS 4 to IFRS 17 in the balance sheet. Let me first start by explaining that the unit of account for the insurance contract standard is a group of insurance contracts. A group of insurance contracts can in its totality be in either an asset position or a liability position. Going forward under IFRS 17, a group of insurance contracts that are in its totality an asset position will be presented separately from a group of insurance contracts that is in a liabilities position. This is a change from existing practice. Existing practice is to set off both insurance contracts that are assets and liabilities in a single line item. The second change is that there will be a simplified presentation consistent with the economics, i.e. that there will be an insurance contract asset line item and insurance contract liabilities line item. Under existing practice, we very often see several line items to do with the same group of insurance contracts liabilities. For example, you could have a policy line item, you could have a premiums receivable line item, and you could also have a claims payable line item, all relating to the same insurance contracts group. Going forward, the simplified presentation will reflect that rights and obligations arise from a group of insurance contracts. Consistent with IFRS 4, reinsurance contracts will be presented separately from insurance contracts. What are the changes to the Statement of Financial Performance, moving from IFRS 4 to IFRS 17? The first key change is, under IFRS 4, it is often very difficult to understand how an insurance business is making money. There is often this change in insurance contracts liabilities line, which is very hard to understand or explain. Going forward, analysts will have the two sources of profit. Firstly, the insurance service result, and secondly, the net financial result. Secondly, the insurance revenue and expenses line are recognized on an earned or incurred basis. Under IFRS 4 today, especially for many life insurance businesses, the revenue and expenses line includes deposits. This is inconsistent with how other industries recognize revenue and expenses today. Thank you for listening to today's webinar. As stated before, we intend to produce a range of materials to support the implementation of IFRS 17. In particular, we will be producing future webinars on specific aspects of IFRS 17.